Okay, good evening, everybody. Welcome, superstars of World Talk 2.0. I super celebrate all of us for joining the call tonight, our training tonight. I would like to actually see how I can assist as many persons as possible. I got some DMs, some persons chatting that they have challenge with one or two things as regarding their accounts, their brokerage accounts, risk management for some accounts lower than $1,000, and for some accounts, higher than $1,000. If you have a specific challenge on money management, please feel free to bring it up. All right. Mr. Kenne, can you hear me? I was saying we are live on the general group. I hope you can hear me now. All right. So if you have a specific challenge, be dropping it on the chart. Anything that does not allow your profitability to be on a steady space. So for any reason your profitability is not steady, let's undo that. Let's work on that. All right. You can put all those challenges, put them on the chart area. So we'll be looking at it as we proceed. All right. So yesterday I actually did just a little of what we are to consider on money management today. I did a little so that I will not keep people for long, since our chairman needed to show us a pathway to hitting our goals. All right. So this aspect is so important. That is why anytime he needs to talk about pathway to profitability, I have to be on ground with him to make sure that we talk about money management again and again and again and again and again and again and again, so that all of us can just, get it right. So all of us can get it right. It won't be that some persons are making profit and some persons are not making profit. And you come to think of it, it's the same trade calls. So how come some persons will make profit on the same trade calls and some persons will not make profit? So what's going on? All right. So for risk management, is just your capital protection, how you protect your capital in the market. All right. For you to trade and be able to come another day to trade is very important. So if you trade today and you're not able to come back into the market to trade, it's one of, it's such a bad experience that you can have on the foreign exchange market. So yes, do we win all our trade? No. But let the losing trade not take out your principal. Let it not take out your capital. So what do you need to do? All right, this comes in four pillars. Four pillars of risk management. And as soon as you've settled with these four pillars of risk management, and then not just to know that, okay, there are four pillars and there are risks per capital, there are risks per trade, there are risks to reward ratio, it is or maximum exposure, is not to know them by what they are, is to implement them. That's what matters, is to implement them. All right. So on the risk per capital, is you just have to come to terms with yourself on how much you're willing to risk or every time you come into the market. All right. So even though there's a set goal, like we know our set goal is for every $1,000, let's look forward to make $250 a day. All right, as good as that sounds, the first thing, once you get $250, the first thing you should do, quickly ask yourself, what percentage is that? Be very fast to check what percentage is that. All right. First thing you do, ask yourself as fast as possible. If, like, okay, our goal is making $250 every day, from $1,000, first thing you have to do is to quickly ask yourself, what percentage is that? And if you check the percentage, the percentage, it's I hope you can see my screen. I'm actually typing on the screen. Can you see my screen, please? Hello, ma. All right.
Yes, Ezekiel, I can see.
Okay, okay. All right. Because if I'm sharing only the slide, if I type, you won't be able to see it. So that's why I need to confirm that. All right. So okay, so for, as we said, for every we make $250 every day, and then we are looking forward to an equity of $1,000. So first thing you need to quickly consider, based on your proficiency on risk management, is what percentage is that? Let that come to you as swiftly as possible. Anytime a year we make this, quickly, what percentage is that? All right. Learn to percentile your profits. Don't consider the figure. Percentile your profits. That's what this that's an aspect of risk management that you must have, embrace yourself, with. Percentile it fast. And if you percentile $250, from $1,000, what percentage that is? The percentage is simple. It's simply 25%. All right. And then you now look at it. Are you in terms with 25%? Because for every uh, profit you are looking forward to make, you should be able to also, consider losing that same amount. All right. If you feel, okay, I want to aim to make 250, you should also, be comfortable losing 250. Yes, you should be comfortable to lose that. But if you not be comfortable to lose that, then do something practical, something realistic. All right, something very, very realistic. All right, all of us, our risk appetite differs. All right, some persons are risk averse. They don't even want, they don't have that, no, they don't have that risk tolerance. They can't tolerate losses. If you are that type, you don't even need to work against your psychology. You're okay. Yeah, a normal human being. You're doing well. That is just how you're wired. You are not wired to take, too much risk. And there are some persons that are wired to take too much risk. And of course, those ones, funny enough, they can make a lot of profit, but professionalism in this market is how much of risk management compliance you are. That's how we rate you, that you are professional. Because everybody can boast of, I have this strategy, I have that strategy, my strategy is 100% and all that. No, how much of risk management compliance are you? If you're not risk management compliance, then you can never be professional in this market. All right, so 25%. 25% is big. Yes, it's big. It's very, very big. All right. So because it's big, you must do yourself a favor to play safe, like safe, very, very safe. All right. Based on this now, you have to consider a lot of factors, like when the trade calls comes, what is the lot size? Sorry, what is the stop loss? And if the stop loss does not match with this 25%, then you have to work with what is realistic, because you can actually work with what is realistic. All right. So risk per capita is, you settle with yourself. I have $1,000. How much am I willing to risk? Am I willing to risk 25%? If I'm not willing to risk 25%, 10%, then while others who has more risk appetite than you are looking forward to aim for $250, you can just humbly aim for 10%, and 10% is $100, and that's no crime. That's no crime. That's how you are. That's how you want to operate, and that's okay that way. All right. That's very much okay. So the risk per capital, the standard is actually like 1%, 2%. 3%, that is the standard. 1%, 2%, 3%, yes. But if you don't want to get rich slow, that's when you now be talking 10%, 20%, 30%. You want to get rich fast. Let me not use get rich quick, so it just sounds like blood money. So you want to get rich fast. That's when you're now aiming for 10% per day, 20%, 30%. You see the way it sounds. There is no investment house that can promise even 10% in a month. None. Of course, I've been a banker for like a decade. That's suicide mission if you're promising 10% in a month. Even in a year, the way we prorate it, we can give you like 9%, but 9%, I find you see our own calculator is different from this straightforward percentage. Oh. Is simple interest. It's very different from this straightforward percentage that you calculate and then you see what it's about. All right. So know that, settle with yourself. Standard is 1, 2 to 3% is what you should aim to make in a day. In a day. All right. Then if you want to go too far, 10%. If you're now going too far, 20%. If you are going really, really far, 30% in a day. All right. Is it possible? Yeah, it is possible. All right. But your level of expertise in this market matters for you to keep up with those 10, 20, 30% in a day. Your expertise must be very high. And even experts try to, do something more realistic, like bring the risk per capita to something low, like between 1 to 5%. 1 to 5%. So anyway, when you start taking your own trades, please keep it within that 1 to 5%. And I don't want to say take it up to 10%. No, 1 to 5% in a day is very okay. Very, very okay. All right. So, but with our goal is 25% that we are looking at. So how do we make this happen? So the next aspect is risk per trade. So this risk per capita and risk per trade, they go hand in hand. All right. Then when you start taking trade is when we'll be looking at risk to reward ratio, because you are the one making you are the one analyzing the chart, and then you are the one setting the risk to reward ratio. How much reward do you want for every time you place a trade? All right. And then uh, let's consider the maximum exposure is this one now. I will tell everybody. Somebody spoke with me yesterday and he said he wants to get a loan to start forex. I said, don't. If you get a loan to start forex, if you're in super, because the demons of that loan will really mess up your psychology that you will not be able to trade, properly. All right. So you can't use all those money that are assigned to something else, like maybe your rents or something, your project or something. No, money for forex is money for forex, not for something else. So don't use money that has a label, a different label for foreign exchange market. So that's about the maximum exposure before you go and use money for other things for forex. So yes, we've done this calculation before. All right, daily standard risk risk per capita. And yes, for anybody that wants to take profit, this is like their standard. All right, you see that you are looking forward to make 0.5%. All right, they call this RST. All right, risk, secure, and target. Risk, secure, and target. That's what this is about, risk, secure, and target. So on risk, secure, and target, which is a standard way to present risk per capita, all right, RST, whoa, coming. So RST is the standard way to measure risk per capita. So for risk per capita, we have it that risk, RST, the R there represents risk. All right. The S, that S there. Okay. All right. The S there. Okay. let me just take it this way. The S represents secure, all right? And then the T represents target. The T represents target. So on this now, every time you're in the market, you're first of all, you find a way to narrow yourself in between 0.5%. That's what you are aiming at. You are aiming at, you are aiming to risk 0.5%, and then you're looking forward to make 1%. You're aiming to risk 0.5% to make 1%. That's how correct it can be, because at least you should be able to risk half of what you are aiming to gain. So you aim to risk 0.5% in order to gain 1%. That's like double of that. And once you've been able to gain that, for any reason you gain some fraction on that, like secure, if the secure is 1%, and somehow the trade was so good and you were able to make 1.2% as your secure, all right, you can try to target 2%. The target is 2%. So risk here is 1%. Risk here is 0.5%. 0.5%. All right. Secure is 1%. And then target is 2%. Target is 2%. So for any reason, you are trying to secure 1% anytime you enter the market. And yeah, your trade was so cool, was so good, and you were able to make 1.2%. All right. So this 0.2% becomes what we call slippage. You've been able to get an extra. That extra is called slippage. So if you go again and you're working towards targets, you're trying to make 2%, which is your target. It means once you hit 2% in profit, you are done for the day. No matter who sends the signal, even if the person is an angel from heaven, you are not entering that market again. And you must be disciplined to follow this RST. All right. It is the standard for risk per capita. You must be very disciplined. So for any reason you want to, use PropFirm in order to have a bigger capital on the side and all that, this will work for you. All right. And if it is your personal capital as well, you can employ this target. It makes you professional. It makes you professional. You can employ this standard. It makes you professional. Now you're only risking 0.5 in a day and looking forward to make 1%. That's to secure 1%. And for any reason you're super excited, you want to go more, you're not going beyond 2%. As simple as that. So with this now, you can trade PropFirm safely, and you can also manage your account for a long time, that you will continue to have that account. Your account will not, you will not lose your account, to any bad trade. You won't lose your account at any point because you're doing the right thing. All right. You're doing the right thing, so you can't lose your account. Oh, sorry, coming. All right, so you can't lose your account. So try in calculating that, we just kind of consider capital. You can consider capital, let's say 200, $50,000, 200,000, $100,000, 50,000, 20,000, 10,000, and then to $1,000, and then 0.5, which is the standard risk. 0.5 for $200,000 is 1,000. You can only lose 1,000 in a day, nothing more than that. And then you aim to make profit of $2,000 in a day, nothing more. And then for any reason the market is looking juicy and you want to go more, don't exceed 2%, which is $4,000. But the thing here is that it makes more sense when your capital is huge. When your equity is big, it's, all this standard works, reasonably. Like your risk is reasonable on 1,000 as against 200,000, then your secure is 2,000. If you are making $2,000 every day, it's a good one. It's a very good profit. It's a very good income to you. All right, $2,000, and then if you are able to do up to 2%, is $4,000. It's a very, very good income, very, very good profit, very, very good profit. But what made it possible? What made it possible is because of large equity. Large equity. So the more equity you have, the easier it is for you to follow the standard. The more equity you have, the easier it is for you to follow the standard. All right, you see how it's dropping. When it's 100,000, you see the risk is 500, then the secure is 8,000, and then the target is $2,000. Yeah, it's still good, still very good. All right, but you're keeping it easy and steady. And what is making it, meaningful is because the equity is big. And yeah, right here, 50,000, 250 is what you look forward to lose as your risk. You look forward to make double of that, 500. And then if you want to go more, like today that is bank holiday, don't go too much. All right. Please, you should have stopped trading by now. So if it's not bank holiday and you want to go more, fine. You can then look for the target, $1,000. So this still looks good. All right. Then for 20,000, you can see risk is 100 to secure 200 and then target 400. It still looks good. 10,000, you only risking $50. All right. But how many persons will actually stick to this? But stick to it. Stick to it. Stick to it. Stick to it. All right. Please put on the chat box. Stick to it. Stick to it. If you can stick to it, it makes you professional actually. So $50, then you're trying to secure $100, and then if you want to go max, your max is 200. So your minimum is 100, your max is 200. And if it's 1,000, you are looking forward to risk $5. Your minimum is $10 in profit. So you aim for $10 in profit, and your maximum you aim for $20 daily. All right. But yes, I know my people. A lot of us will not want to stick to this. All right. But if you want to go beyond this, just be ready to match it with equal risk. If you want to make more than $10 on $1,000, or you want to make more than $20 on $1,000, be open to taking more risk. So your risk you can't be aiming to make to risk 0.5 and you want to make $250. You have to make sure that your risk too is higher. All right. Make sure your risk is higher, and make sure if you're taking the trade by yourself, do everything you can to learn better so that you'll be able to you're open to more risk, and then you're also open to more profit. All right. But your skill must be very sharpened, must be very, very sharpened. All right. Some persons that didn't join the call yesterday, we did this calculation yesterday, and on this calculation now, let me see if I can enlarge this. All right. So what we're calculating, we're looking at that $250 we are supposed to make on a daily basis. And then the $250 is for those that has $1,000, so not for everybody. So how can we make that happen? To make that, we simply say that we have to check the stop loss. The stop loss is the determinant of the lot size we are using, the contract size. Right? The contract size is the lot size 0.01 or 0.1 or 1. But what was recommended is 0.1 as the contract size. 0.1, 0.1. But we did the calculation. So the 250, like when we started, I told us that 250 is 25%. So you bring that risk amount here, 250, and then on the average, we are always taking a 100 stop loss or distance. All right, that stop loss distance, I did that calculation for us yesterday on stop loss distance, and I was telling us that in case you don't know how to calculate your stop loss on gold, please just movement per price. If 4669 move from 4669 to 4670, that one movement per price is 10 pips. If it moves to 2 movement per price is 20 pips. 3 movement per price is 30 pips. 4 movement per price is 40 pips, and 5 movement per price is 50 pips. So on the nutshell, from 46690, or let me just use something that we can easily understand. So let's say from 46660 to 4605. That's 5 movements per price. So 5 movements per price. So the pips value between this and that and the other one is going to be 5 times 10. All right, it's simply going to be 5 times 10. Sorry, let me take this out. All right, so it's going to be 5 times 10. And then when you do that 5 times 10, 5 times 10, then you are able to know the pips value right there. 5 times 10. So in the event our entry price, let me bring this up now. Let me bring this up shortly. All right, I did a screenshot here just to show us something quickly. All right. It's coming up. Please hold on a bit. All right, so I screenshotted this just to explain something to us. So in the event you have this now, all right, you have this, the entry price. Let's say the entry price is like this. The upper bound, is always in range. The upper bound, it is how can we see this well? All right, we should be able to see it well now. All right, so the upper bound, let's say the upper bound is 4603. All right, and then the lower bound is 4598. So we are expected to enter the market, based on this range, whether we come in at this point, all right, or we come in at this point. All right, let me do that again. So we are expected to come in at this point, or we come in at this point. That's what is expected of us. So yes, since this is a sell, it's going to make sense at this pullback. Maybe when the market just came to this point, you already jumped in. All right. Then if you're jumping in there, maybe just one position. And when it gave you the pullback, then you enter the second position. All right. So your stop loss is right here. So you check the difference between this now. Difference between 4603 to 4606. All right. I was just using this as an instance based on what I saw. Anyway, so from 4603 to 4606, the stop loss is 30 pips. 30 pips. But most of the times, our stop loss is always 100 pips. All right, it's always 100 pips. So you should be able to now to calculate how do I know this is 30 pips. So 4603 movement per price from 4603 to 4604 is 10 pips, to 4605 is 20 pips, to 4606 is 30 pips. And if it continues like that to 10 pips, that means we are going to put our stop loss at 46 what now 4613. Good. So our stop loss is going to be at 4613. That's where it will be. All right, and then you allow it to run, and then you take your profit. All right. But this 4613 that you're putting is the determinant of your lot size. All right. But just have a way that your mind can quickly tell you what your lot size is going to be like. So if it's for 100, if it's for 100 stop loss distance, your maximum lot size is 0.25. How did we get that? We just put 250, which is the risk amount, our risk amount. We are comfortable with 25%. So 25% of 1,000 is $250. And then the stop loss based on that entry, signal is 100 times 10. All right, that gives us 1,000. And then 1,250 divided by 1,000 will give us 0.25. This 0.25 is simply our lot size. So our lot size is 0.25 maximum. So this does not mean you should use this for one position. You have to use this for the three positions. All right, the three position right here. Where is my chart again? All right, this let's say this is a trade call. So let's say you have one position on the lower bound, and then you have the remaining two positions at the upper bound. So you would have distributed your lot size. You have to distribute them. Yeah, at this point, use the lowest one here, 0.05 lot size here. Lot size here, and then as the market pulls back, all right, you can now use the remaining, which is 0.1, and the last position you also use 0.1. You've distributed it. All right, I hope we can relate with this now. So you've just distributed it, correctly, and then you watch it run. All right, so this one now that you put here is the one that should be your TP1. Let this leave the market on time, and then the remaining two, you can now try to ride them until they get to your TP2 levels and then your TP3 levels. All right. But this one that you enter too early should be the first to leave the market. You have to make sure that you have to make sure of that. Let that leave the market very much on time. And once that leaves the market, you see you breathe well. You'll be able to breathe well, like, yes, you are in good position. And once that has left the market, break even. So after you've broken even, then you can breathe well. You'll be able to manage the remaining trade successfully. All right. So that's how this works. All right. So if your funds is not up to $1,000, please check your category. Check your category and then find a way to know the exact lot size you're supposed to use. So I'm just going to pick the least one here and then, figure out what the lot size should be for 1%, 10%, and for 20%. And then that's about it. So for the last one, we quickly pick this now. All right. So let's say duplicate this. So now for $100, for those that has $100, if $100 should not expose their account to 25%, that is too big. All right, 25% for $100. At least maybe 10%, but let's say 25% is going to be $25, and then this is going to be 1,000. You divide 1,000 by, you divide 1,000 by 25. That is what is your maximum lot size. Divide that by 25. So your maximum lot size will now be 0.025. That's your maximum. So with this maximum now, then you are simply going to divide this into three positions if you are taking three positions. So your first position can take 0.01, second position takes 0.01, and your third position will take, this is more like you should take 0.005. But of course, the least the micro lot is 0.01. So you can just you can leave, forget about the third position. All right, that's my recommendation. Forget about the third position, run with 2 positions only. That's how you can play safe. So if you're running with 2 positions, it means your total lot size is going to be 0.1. All right, for that 25%. For that 25%. And then if we want to do from, we are doing for 10%. All right, 10% is going to be $10. And then we divide this by $10. We divide this by $10, 1,000 by $10. I'm picking the average lot size. If the lot size is more than 100, please make sure you reduce your lot size much more. So if you divide this by 10, 1,000, 10 divided by 1,000, you are going to get 0.001, 0.01. That's what you get there. So it means if it's 10%, you're aiming to all right, to based on if you're aiming to reach 10%, and then your contract size, the lot size, is also 0.01. That's the maximum. It simply means you can only take 1 position. All right, Mr. Is it Suru? I've forgotten your name. Let me check whether he's on training today. Sopuru, yeah, I can remember. Mr. Sopuru, after a while, you came to ask these questions on Tuesday. We are repeating it now. So you can see why $100 should only take 1 position. This is the reason. All right. That is when you are even looking forward to making what? To risking 10%. You're looking forward to risking 10%. So what you want to risk is the determinant of your contract size. All right. So, and if it's 20% now, for 20%, let's take for 20%, means you're open to $20. And then you have this divided by 1,000, and then your max is going to be 0.2. So if you are risking 20%, that is simply when you can actually, take 2 positions at 0.01 each of the position, because you are open to risking 20%, and your total is going to still be 0. This. All right. This one, your total is 0.2 as well. Right. This is supposed to be 0.025, but we can't take the last position. Our lot size is supposed to be 0.005, but there is no contract size like 0.005. No broker is going to give you that contract size. So hence, the 25% target every day, we can only take 2 positions for $100. All right. And if you are only open to risk 10%, you can only take 1 position. And if you want to risk 20%, you can only take 2 positions. So everything is interwoven. So you don't just do things randomly. You should know why you're doing what you're doing. All right. Know why you're doing what you're doing. So in this case now, we've done calculation for this. It simply means you can only take 1 position at 0.01. All right. And on 20%, you can only take 0.01. All right. With another 0.01. All right. So that's for everyone with $100. So for $300, all right, if you feel like you should do it, because you should do it, this should be on your trading plan before you even come and resume to start trading for the day. You should make sure you figure out your risk, your money management, your contract size for the day. At least calculate it on 100 pips. That is the average we can take. And for any reason you now see that the trade call that you got is more than 100 pips in stop loss, quickly revisit your money management part of your trading plan and adjust your lot size as fast as possible so every other aspect can be balanced, right? Because if you don't settle every other aspect, it is not balanced. And when it's not balanced, you are just kind of putting your capital at risk. All right. So no analysis is 100%. Hence, what you can do to keep yourself safe is to make sure that your risk management, your money management is top notch. All right, it's top notch. So when people are joining or are starting the academy recently, are like, oh, they didn't, they didn't do well on their trade. It's because they don't know money management. All right, I've taken my time to do the money management, and I'm going to give us, as an assignment, please work out what your contract size will be. All right, at 100 stop loss for 1,000, for 700, for 500, and for 300. Do that math. Do that math. In case you have more than, maybe more than 300 you're trading with, you can quickly know what to do. And if your own capital is not among this range, please add your own to it and do the math so that it can stay with you. You might not go and start calculating aside when the signal is called, but if you have settled with your money management before the trade call comes, you know exactly what to do. All right, you know exactly what to do because you've calculated what your lot size will be for any trade signals you receive. You can even do yourself a favor by calculating for 100 stop loss, calculate for 120 and calculate for 150. Because some stop loss is up to 120 and 150. So if it is 150 stop loss you get, you know the lot size you're using. If it is 120 stop loss distance you get, you know the lot size you're using. And then you're not confused at any time, or you're not using wrong lot size at any point in time. Because if that trade hits stop loss, it's 3 position, your account will bleed. Your account is really going to bleed. Each of them like this 25%, if it hits stop loss, it means 250 times 2 plus 250 plus 250. That means your account will will be in drawdown of how much now? $750. Did you get that now? You see why money management, risk management is the core, is very, very important. Yeah, psychology is big, but this part, all right, is what psychology is even pointing to. All right. If that trade doesn't go well, it will be 25% times three. Because this 25% we are talking about is we are looking at it as if, okay, as if it's one position. Okay, yeah, we are still in order. True. Sorry, we are in order. Because the maximum is 0.25 and we've broken it down. Good. So for anyone that, yes, you've been asked to only do 0.1 based on what we've calculated here, and we saw that that's what is ideal. And you're now like, you want to make money more than the rest of us, and you're using 0.2. If you're using 0.2, if that hit stop loss is about $200 times three, so you've lost 600. You've lost 600. That's what it means. So when you want to increase your lot size, know that, just know, what's it now? Just know the danger of that, the danger of increasing your lot size because you want to make too much money, start increasing your lot size unnecessarily. Know the danger. All right. So that's it. Let me pause there for today. If you have question, please bring up your question. Let's respond to you, and then let's call it a night. Questions on what has been challenged to you, being profitable, or anytime you take trade, what is the challenge? All right, challenge to profitability anytime you take trade. Anybody? Do you have a question? Let me check. Okay. KOO, is that you?
Yes, sir.
Okay, you
What's
are
the
asking
formula for
why are you
calculating
dividing by 1,000 for all?
for all? Yeah.
Okay, okay. The standard is this is the standard. If you for your lot size must be your risk amount. Our risk amount, based on those that has $1,000, we kind of let's try to make 250. In as much as you want
Yeah.
250 in profit, that means your risk too will be 250. It's 50-50.
Yeah. I
All
do
right.
understand.
So
I'm
that is
talking
how
about for $100. Why are you dividing by 1,000 to
why while
100?
I'm dividing by 1,000 for $100 is because if you're taking signal, most of the signal, their lot size is 100 pips. And based on the standard is that you must multiply that stop loss, sorry, that the stop loss distance, that's 100. You must multiply it by 10. So if you multiply that 100 by 10 is 1,000. But if it is 150, you multiply, it will even be more than 1,000. If it is 150, it's going to be 1,500. If it is 200, it's going to be 2,000. So you are dividing your risk amount. If it is $25 you want to make for $100 now, it's going to be 25 divided by 150. If the stop loss is up to 100, it's divided by 1,500. If the stop loss is up to 150, and if the stop loss is up to 200, then it's going to be divided by 2,000. So that is how that 1,000 was added to it. All right. So yes, you may not really, if you do this calculation now and you settle with yourself that this amount I have to trade, this is if this is the lot size I'll be using, you don't need to do this calculation when the market, when you're already taking trades. You already know it and you must not go beyond it. All right. So Mr. KOO, why we use
Yes,
1,000,
sir.
I've explained to you, is the standard. And then if your risk is 25%, then you should know that your lot size is 0.1, 0.1, and you can only take two positions. Here you took three because you have more money. Here you are taking only two. All right, only two positions. All right, and then right here you are taking two positions because you open yourself to more risk of 25%. 25% is a big risk. So you're opening yourself to more risk. That's why you can take two positions. Then when you try to reduce your risk to 10%, that you can only take one position. All right. If you reduce your risk to 10%, you can only take one position. And if you increase your risk to 20%, you can only take two positions. Those are the points. All right. If you increase your risk, you can take more positions. If you reduce your risk, you can take less positions. So you can't say you want to reach 10% and you're taking three positions. You don't understand it. All right. All right, Mr. Keoho, hope you're good. You get it right. All right. Any other question? This is really well explained. Okay. If I'd known this, oh, I wouldn't have blown my account. Oh, what happened? So sorry, Mr. Joseph. Sorry about that. Now you know it, so you won't blow your account again. And always give us feedback how you are able to stick to this because it's easy to do what we've done now, but will you comply? Will you comply? Because if you don't comply to it, you will complain. Oh, and the market has not done you anything bad. It's just because you refuse to comply. So if you can comply, you'll be fine. All right. If my risk is 10%, I can only take one position. So everybody, you go and type on the chat box, our general chat, state what your risk is and tell us how many positions you can take, per time. So state it this way: if my risk is 10%, I can only take one position on $100. All right. If my risk is 20%, I can only take two positions on $100. And if it is 1,000, if my risk is 20%, I can only take, three positions on $1,000 with 0.1 lot size. All right, I want to see you write that on the group. Please kindly go and type that. So that is a proof that you understand this now. State it based on your capital, all right? But sound like, like sound probabilistic. Use the if word, if my, if my risk is 25%, I can only take 2 positions at 0.1 or 0.01 lot size. All right, state it like that. Please, let's state it on the group. That is how you can allow it. That's how you can communicate it to yourself. Good. All right, that's what one of my mentors taught me. All right, as you're learning money management, communicate it to yourself. Let it stay with you. Communicate it until it stays with you. So when you see 3 positions, you know you can't take more than 1, and you must not take more than 1. So if you take more than 1, what are you doing? You are over leveraging. You are over trading. You are over leveraging. You are over trading. You are over leveraging. And if you over leverage and over trade, please, you carry the cross. You carry, you carry the liabilities. Do you advise we use $50 to trade, or use it to buy a prof? If you are new, Prof-firm conditions you might not really scale through prof-firm conditions if you're new. All right, but with what you've been taught on risk management now, that's one side. Then you need to know how to be able to analyze the market and trade by yourself. But if you want to use Signal to do that, yes, you can actually buy prof-firm and use the Signal to trade, and make sure you employ the risk management you've been taught. That will help you to succeed. Yes. And if you want to use $50 to trade, you can see is there any room for $50 here? If you want to use $50, that means you might have to reduce your risk maybe to 1%. You might have to reduce your risk to 1%. So Joshua calculates, you risking 1% of $50, and then what your lot size should be. You might have to reduce your risk to 1%, because even 10% can only take 1 position at $100. All right. So if it is 50 has to reduce its risk to 5% or to 2% to be able to take at least 1 position. All right. But some leverages can make you take more than 1 position, but you are risking too much when you are taking more than 1 position on $50. Right. So you can make money with one position on $50 and grow your money faster. That's okay. All right. So with Signal, $50, you can still trade with it, but small money is very stressful. I can tell you that for free. All right. So small money. Okay. So small money will make you stress yourself on the market. So it's better you just find a way to come to the market with at least $300. But in the event you can't do up to $300, then maybe you can now try and do like $100. You can try that. So yes. Okay. All right. Okay, so I don't know if there's no other question, we'll be calling it a day. All right. So what we have right here, what I have is just what I showed you on how to place trade on upper band and lower band. This is the link. So after now, I don't think I need it anymore. All right. All right. So thank you so much, everyone. All right. So no more question. Please don't forget the assignment. Go and state on the general group. All right, the if statement. If I'm risking 25%, or if I'm risking 10%, I can only take one position, or I can only take two positions, I can only take three positions. Please do that, and I'll be glad to see you do that. If you don't do that, if you ask me for a personal assistance, I'll go and check, did you do this assignment? If you did not do it, I will respond to you. All right, guys. Thank you, superstars, and God bless all of us. Since there's no more question, please trade carefully, trade safe, and trade profitably. Thank you, and God bless you. Good night, everyone.